All right, so good morning again. Since most persons not training or trading today, thought this would be a good opportunity for us to just have a little chat about markets, low probability markets. What do we look for in low probability markets? Stuff like that. So let's grab a M5 chart. I won't deviate from my M5 chart. I'll just include as much charts for persons as possible. All right, so typical stuff. The process would have been the same. I've not checked an economic calendar because I'm personally not trading, but I'm gonna do that real quick. Economic calendar for today as 9 a.m. a couple hours from now. Paul is speaking today. So that time should be volatility injection. So before the news event comes in, I mean, we all know that the news event is just an excuse to move the market. So get these off. Do you need them? Not add. Look at not add as. There we go. I'll add S&P because I also have someone that trades S&P. There we go. So that should be enough. I'm using this M5 chart, which specifically outlines Asian range, Asian deviations. You can see those here, London range. And we have this box starts getting drawn at 8 a.m. So as usual, if I was just looking at the price action and I'm looking for the liquidity, I always start like this. Not necessarily this time frame, but this process. This is the start of the day. London, I mean Asian here, London there. I want to look at the relationship between the sessions. That's very important. If we have sessions doing the same thing, then it's very likely that we're going to get a continuation in New York, meaning if Asian is bullish, London is bullish, why would I go in the market expecting New York to not be bullish as well? So we always want to look at previous sessions to get an idea of where the order flow is, and then we start looking for liquidity. Order flow, liquidity. That's simple. This right here, we have Asian tight range, Asian low was taken right here. So nothing entry related as yet, just looking at the price action just to read what's happening. We have Asian lows taken. So because London took Asian lows, we're not expecting big sell below here. This wouldn't be liquidity if this is taking liquidity. So the next part to look at would have been Asian high. London didn't take Asian high. So we are expecting liquidity to be above here, but we already have that sweep. So we have liquidity taken here, liquidity taken here. So in the aspect or in the scope of looking at the market from this day, we now have no liquidity resting for today. So I have to go back and look at previous day's range to find liquidity. So you won't hear me talk about previous day's highs and lows a lot unless I'm looking at it from this context. So if you just scrub real quickly over to previous day's range, what do we have? London lows intact after taking liquidity. So Asian lows at liquidity, London took it, no need to go lower. Liquidity now would be London high, Asian high, and then any liquidity from previous day. You can see all that gets swept here. So this is the high that takes liquidity. This one, this high took liquidity. If this high took liquidity, there is no liquidity here. Make sense? Well, if this high took liquidity, there is no liquidity. We have another short-term high here, failure swing. So now, from a purely market structure perspective, we have high, low, higher high. sorry, lower high. So now most persons are looking at this and expecting it to be bearish. Some persons are shorting here. So if persons are shorting here in this scenario, where would they put their stops? Here. And of course, the persons who are more open to risk would start putting liquidity here. This is how liquidity gets built up in the market because persons are reacting to structure. No liquidity, failure swing. You want to get short here, liquidity, liquidity. No liquidity down here because this already took liquidity from here. This low is now a short-term low. Persons would be starting to buy this because this would be a shift in market structure above this high and above that high. So persons are now inclined to say the market is bullish. So start pulling here. This is how I look at the market to try to find liquidity. So now since there's liquidity here, sort of in the AM session, if this high in the PM session took liquidity, your bias would no longer be bullish. We'd be looking back at previous price action. If this took liquidity from over here, failure swing. Why is this a failure swing? Take a look at this bit of price action. Looking primarily at that low, that high. This is an expansion swing. This is a range. So liquidity would have been above and below the range, right? Not expecting all the way down here yet without seeing the market take these and the fair value gaps inside here. But take a look at this price swing right here. This is the start of it. The order block breaks above, comes back. Then we push higher and take stops. So your range going into the afternoon would be there to here. So if we're trying to find out where stops are, and these stops have already been taken, here's that big up candle. You can watch the lows for order pairing. So this is the first load. We close below it. Yes, market structure shifted bearish. Well, the market structure shifted bearish right here at that candle high. Right there. When this candle closed, market structure was bearish. See the reaction right there? Order block gets created, huge push. So we have an order block that creates a push that breaks previous structure right there, which makes this a high probability order block. See the reaction right there? Keeps breaking low. Order pairing at the low, low. This is now the target. We can see all that reaction. So what I just said and how I just described this price action is probably sounding a little bit simple. If you listen to it carefully, you'll realize I just said a lot of things that are very important to how you view price action. So next day, same idea. Take in, market pushes up. Right here, there's that shift in market structure. Market structure shift happened right here. Someone's in the chat. For me, 3.5 deviation is like a range limiter. So if it pushes 3.5 deviation, I expect it to stop. Depending on the pip count of the range, I may split that and use half deviations and then focus on that level as well. But different contexts. So based on what we just described right here, after the stops are taken, the failure swings will hold liquidity. Stops taken here, failure swings will hold liquidity. So if my bias going into New York for this guy here is bullish, I already have my levels that I should focus on for liquidity. Short-term low, short-term low. All of these failure swings, as you can call them like trendline liquidity. Yeah. So where's that drawing thing in my jiggy? Here we go. So let's say we have a stop hunt. Pushes up, fails to go below here, which is fine and it should fail. These are all failure swings if they fail to take out previous lows. So because most persons trade purely structure and trend line, what they are seeing is trend line bounces, trend line bounces, trend line bounces, right? So they're looking at buying the bounces. We are looking at liquidity building up at each of these lows, especially if the market keeps going higher and is not taking any of the liquidity. Bullish market will always pair sell side liquidity. Fact. Market makers buy sell side and sell into buy side. So if the market's bullish and they're not taking sell side, that's suspicious. I'm not waiting for that kind of run, then higher or all the way down here. But these areas are areas where you start stalking potential setup. And it's recorded, it's recorded. So this right here looks like a basic pattern, but it's much more than that. But anyway, these are the levels to focus on. Cycling through a couple other pairs. Let's take a look at these. Asian high, not taken. London high didn't take that right there. So this would have been the first high of the day. And then this is the failure swing. So this will house liquidity. So we see London breaking lows, breaking lows, breaking lows, right? No liquidity is down here since this is the last low and then this is the lowest one, which means this had liquidity and this took it. So whenever you're looking at a stop hunt, there are always signatures in the stop hunt that you can look at, and it tells you way before price gets up here if this is bullish. For example, when this big candle closes right here, it's a shift in market structure. That's when the market structure starts to shift. There's a lot of reasons why most persons might consider that a shift, but the reason is quite simple. But that's a shift right there. So if at this point in time, you consider the market to be shifting bullish, what would you be expecting? A run on highs, order blocks, fair value gaps over here being created and then filled in. That's exactly what we see play out after this candle close. Order block, push. This is the high that needs to get taken. It's taken here, small console, and we push, and then we're back inside London range. AU potential sell. Look at AU in a second. So again, if the market's bullish, this is the liquidity. If you believe the market is overwhelmingly bullish, then you look back for liquidity levels that weren't taken from the previous day. Short-term high, because it's a failure swing. And you can do it on any time frame you want. So that would have been the focus. This drop in gold was already expected from yesterday because of different reason. EU here as well. We have Asian high, not taken, failure swing, liquidity. Take a look at how we broke the low right here. See that? Huge aggressive selling. Aggressive selling through here. Stops that would have been resting here, we're expecting market makers to buy stops at the low. They didn't. There's no selling, there's no buying taking place here. There's a whole lot of selling though. So the entire London range was a big selling party. Let's call it that. So now, based on what we have right here, we have a small Asian range and a very huge London range. This right here almost always sets up a buy for New York. This structure right here. Okay. Why? We have a very huge trading range already being created long before New York. Markets, let's see how big of a range this is. This is a 96 pip range so far. So the daily candle is already 96 pips. I don't know what the average daily range for EU is, but I don't think it's 200 points or 200 pips. So when we have a very large London range, it sets the stage that New York is likely going to trade between these points. So we start looking for liquidity to the upside or imbalances inside London that we could trade to. Or if you want to get fancy, you can talk about the order blocks inside London range. So the start of this huge impulse would have been these 3 bearish order blocks. That's where we could watch for more selling. The lowest down candle in London would have been this one. So this is where we could have watched New York for more buying. New York opens in here. Here's your bullish order block. There's a reaction. All of these highs would now house liquidity, and this is a huge imbalance. I'd start my imbalance at Asian low and stop it right there. So that's a huge imbalance that is likely to get filled in New York. So we're approaching New York with a bullish bias. When you have a bullish bias, there's only 2 things you should focus on: a run below sell side to pair liquidity, or bullish arrays inside the range. The range here is London high, London low. Already identified the bullish arrays. Already identified New York bullish arrays, order block, fair value gap. That's interesting. This would be a nice buy if I was trading euro. Where would I target? This imbalance here. Before I take a trade from the order block where I plan to enter to my targets, they have to be at least 15 pips. It's midpoint. So this is a potential 60 pip trade, which means for whatever reason, if I am late to the party, because we're human, we can miss, right? You can plan your trade and still miss. If I'm late to the party and I get a valid setup, as long as the setup is, measure from here to here, below half of the range of potential opportunity, I know that this is a 60 pip range. So from the 50 level to here is 30 pips. If I get an entry anywhere down here and it runs to the objective, I'm guaranteed at least 50 pips, at least 30 pips. So this takes the stress off of you trying to squeeze out the RR out of the market, but work with what you have. This is a potential 30 pip range. If I get an entry anywhere down here or exactly at 50%, if I have a stop that, let's say 10 pip stop, that's still a potential 3-to-1 trade if you're adamant that you want to be an RR trader. But I know that if I get a entry that's less than 50% inside the discount end of the range, then I'm looking for a very nice trade. All right. I could easily have a, let's say a 15 pip stop and still get a 3-to-1 out of this. So that's trade planning. Hopefully that wasn't too cryptic. But yeah, this is the range of opportunity. You know what you want to look for here. If all of your analysis is done on a 5-minute chart, don't cycle through another time frame trying to validate or invalidate your trade. That's the plan. Stick to the plan. The plan is I'm going to look for buys down here. All you need to do now is find out where to look for buys. Order block FEG combo, I would buy here, but I'm not trading today because this entire week feels low probability. But you can still train and study the price action. This is how I would study. The one pair I hate more than anything else, GU. So same idea. Asian highs, not taken. London highs, already taken. Asian lows taken by London. So I'm expecting London lows to hold in the market. I'm bullish. This is the trading range. New York is opening premium end of the trading range. I would like a run to discount to get a trade higher. Am I going to short this? Not really. Not a big fan of that. If I was going to short it, where would I short it? Because I know some persons would still want to short. I'm going to look for imbalances like these. Fast moves that suggest order pairing. Try to get involved there. targeting here when price gets back down here. What time of the day is it? It's 8:49 New York time, 7:49 my time. Nothing significant about 7:49, so I wouldn't be stalking entries here. So even though my bias is clear, time of the day does not suggest I take an entry here. So at 9, I'd like to see some wild behavior, and I'd potentially entertain a trade idea. Can we go back to gold quickly? That was a theoretical entry for bias, so it's buy side liquidity. If my bias for gold was bullish, I'd be entering right here. This is a rule for me. This is a rule. I'll outline the rule. Show you what I mean. If we have a high like that, and the market breaks the high, we all consider that as a shift in market structure. So retracements here lead to you being bullish, going long. So I've taken that idea and refined it with actual price action data, not theoretical chart patterns. And I've come up with a rule, a very simple rule, where if the high gets broken here and a pattern forms here, I anticipate where the entry here should form. So based on this right here, if I said that this candle here, that up candle there, was when this candle closed, the shift in market structure was confirmed based on this structure in here. Once this candle closed, that was a confirmed shift in market structure. So when we start going lower after a confirmed shift, I'll be willing to buy that. And there are signatures in here, like I said, that I would buy. So that's it for gold. And then the target would have been that high. Correct. Since we close above the FEG. Swap the NAS real quick. All right, same idea for NAS. We have Asian lows where they're taken. Yeah, we had a wick through Asian low in London. So London took Asian low. London also took Asian high. So we're looking for failure swings now to house liquidity. Okay, so take a look at the market structure here and we'll look for the failure swings. In this view, failure swing here, that's taken right there. Market moves lower. This is the next failure swing right there. So my focus would have been on that high. That would have been liquidity for me, but I don't trade at this time of the day. I don't trade inside here. So now looking at this bit of market structure, where's the price I would focus on? Where is that? I'd be focused on right inside here, below that low. I'd be looking for price to sweep that low down into here. If we get a clean delivery, when this high was already tagged it, when this high was broken, order pairing, came back, tagged it, and then moved. I'd be looking for another wick inside here or lower to give me a setup to go long. Then we could start factoring more upside. So from a 5-minute perspective, those are all the things that I would be factoring in to get a trade. So buy is below here. Buy is below here. This is already in discount. We've already identified the London and New York order block so far. This is now a failure swing because this is lower, right? Do we sweep them both when the news comes out? I don't know. Let's see. Gold, I would have already been inside this trade and then targeting internal liquidity from London with my eyes on the highest closing order block in London that we could see a reaction from it. London order blocks tend to be very sensitive. So I'd be looking at that. This is a void in here being filled. Also, a low is broken here. So potential order pairing happening right there. S&P, same idea, looking for a rundown here. So from a 5-minute perspective, those would be the only things I'm focused on. Now, today's what, Thursday? Ah, look at that. From a 1 hour perspective, let's take a look at trading range. What do we have here? We have this here being the highest high. This is a long wick candle, right? Whenever the market has a long wick candle, it's doing one of two things. By now, we would have seen them a lot, but maybe you haven't classified them. So let me tell you how I classify them. Long wicks either take liquidity or rebalance. If they rebalance, they'll have liquidity. If they take stops, they won't have liquidity. So that's a rule. It's a very simple idea, but that's a rule for me. I don't do mentorship, just at a 1v1 group. So yeah, there we go. Long wicks either house liquidity or they don't house liquidity. When do they house liquidity? When they rebalance. Let's talk about this after, please. If they take stops, they won't have liquidity. So what I'd focus on is failure swings after these form. Same idea. So if we take a look at this structure here, we can go back to a move that's played out a long time ago. You could backtest. Look at highs that are formed and then the failure swings that are formed after those highs. There's always a signature there that tells you where the market's holding liquidity. You may have to pay attention to the market structure a little bit, but it's going to be there. So for me, if this was a trading range, right? This was a trading range. That would have been the high of the range since that's a stop hunt. This would have been the lows down here. We're now in the premium portion of this range on a higher time frame. So what would be the significant portions of price action that you would pay attention to right here? So at the high of the range, we have 3 consecutive up close candles. We could have sells being formed up here. At the low of the range, what do you term of trading range? Trading ranges are always dependent on a higher time frame. It could be any time frame depending on how fast or how long you're going to stay in the market. But you want to take a look at the most recent highs and lows that the market is trading within. Once you have those, then you have an idea of where the market's trading in, where the liquidity levels are, where are the current stops in the market, and you could use those to frame a trade idea. Good morning, Bran. So with that being said, these are the highest closing of candles in the range, and this is the lowest. So I'm gonna make this not gonna focus on precision filters here, just narrative and context. So up here is where you'd be focusing on getting a sell. So this potentially could have given you a sell if you had this idea already outlined, all right? All we need now is time of day to overlap, or I don't care about this. This candle was formed at a time of the day that I don't trade. Wait, lies, this is NAS, so there is a PM session for S&P. So bam. Let's review that in hindsight. This would have been at stop hunt. Now, if you have watched the video that I spoke about my trading model, for anyone who doesn't know it at this point, my trading model is here, 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 here. Keying off that high. That's my trading model. When we have a higher time frame key level gets formed, let's call it that. My model forms like this. Failure swing, drop, stop hunt, drop, comes back, entry, go. This is how my model forms around higher time frame key levels. So since we already outlined, no, not necessarily. I focus on catching the start of the move. Reversals are, I mean, you can catch reversals with the model. You can, you really can, but trying to catch a reversal would mean I'm trying to enter right here. I don't usually enter there. I'm usually entering here on this retracement. So not necessarily a reversal, but the start of Ninja. This would have been the start of the move. So if you're a big market maker fan, this would have been like smart money reversal, and then this would have been like low risk sell. Yes, good idea, or a good little way to look at it. Targeting these short-term lows. So that would have been your range. We're looking at the lows here, significant lows, ones like this that precede a stop hunt. And that would have been a nice target for you to focus on. So just going back to this higher time frame and the model and how it's formed, we have market running through here, taking the stops, and we're closing below here. So right here, market structure shift. Once we close below that blue line, bearish. Fade the retracements. A stop up here might be a little bit too far, but a stop up here should be safe. This is what would give me confidence that the market's going to go lower. And then targets are easy to find. Entries are a little bit harder to find, but with patience and a solid rule, you should be fine. Primarily, I work with H1 charts. I can trade a daily chart or a hourly or a weekly chart or anything like that, but I like a hourly chart. Nice and easy to use. So just switching back to the analysis to kind of have you guys see it play out. Gold still bullish, running up, waiting for, I think this gray box here is 9:30. Oh, it's 9 o'clock. No, so Paul is speaking. I should see some excitement in the market. Want to see price down here for NAS. What does R equal means? No, oh, this is the range. This is an indicator that automatically calculates the range for me, because based on the pip count of the range, there are some gymnastics that I do. Right? So for instance, if I'm looking at the range and I'm going to use range projections, if the range is a very large range, I don't expect a million pips to form with a large range. Usually, from my back testing and studies, if the range is large and I split that range in half and use half deviations, I get much better price targets. All right? So I'm going to give you an example. Let me give you an example. So here, the range for London is, scrunch this up a little bit, 124 points. That's what it means, 124 points. So for London range, this is not a particularly large range for Wednesday, right? For Wednesday, this is not a particularly large range. So if I was looking at range projections, I would have this. Just duplicating the range. 1, 2, 3, 3. Right there. That's 3, and then the half deviation would have been on the top. Just anchor it in the middle right there. So this would have been a 3.5 pip deviation for NAS if I was using this range, and I would have been targeting that price level, right? if we used half deviations, I think it should be popping up now. That's right in the halfway point. That would have been 1, 2, 3, and then a half. So using half deviations, I'd have gotten this. Now, is that worth my while? That's 210 points. If I can frame a trade idea that's 210 points, then I'm fine. What's this? Do you use Asian range or deviations? I barely use Asian range for anything these days, to be completely honest. I barely do it. What I do look at for Asian range is if we are having, or if we're getting deviations of Asian range. If London, for instance, is lining up with one of these deviation levels and we're getting reversal patterns formed, it's almost always a guarantee that it starts at turning point. So here we have London lows being formed around about 1 deviation. Then we have a reversal. 1 deviation is ideal. Here, London lows is not formed below 1 deviation. It's formed inside Asian range. All right, so this was possibly Asian trading above a short-term high for breaking market structure or shift. London comes down, gives you your entry, moves away. New York respecting London order blocks, then we rally. Here's another example. Asian range, again, we don't have London forming at the Asian range. We have London inside the Asian range. So I'm looking for the shifts. New York comes back down, gives me my entry, and then go. Nothing forming here around Asian. Everything is keying off of London. So I can't say that it's a solid idea. It's a concept I've used in the past. Great success. So not going to change it now. So what do we have here? GU still pushing, EU pushing, gold pushing, S&P still doing nothing. All right, so a quick so how do you use the CBDR? I don't use the CBDR. I'm an ICT student, but I don't use every single ICT tool. I don't use SMT either. How do I incorporate time cycles in my trading plan? Who said time cycles in my trading plan? We have a minute left before Zoom ends this call. So yeah, you don't need central bank leading range, but let's hop on 9:30 again. I can do another call. All right, enjoy the rest of your day. Until then, guys, see ya. Definitely.